Hey guys, I just wanted to come and make this really quick video to kind of address some of the questions that I see online, particularly on social media, in regards to where is the best place for me to put my money? What should I be doing? What type of account should I have as I start to make more money and start to accumulate assets? And so there's kind of this raging debate that's going on, and a lot of people there's a lot of noise around IULs, Index Universal Life, and infinite banking and be your own bank, and kind of all these other concepts. And so what I wanted to do is kind of take a minute to kind of rank these accounts, right? To kind of, put them in order of, importance, and, kind of just give people a general guideline, right? Of how to think about these accounts, and, what you should be thinking about when you go to open these accounts, okay? Or before you go open these accounts, because each of the accounts that we're going to talk about today have upsides and then they have downsides, right? So I want you to consider the pros and cons, and I want you to be informed, right? So when you're working with an investment professional or an insurance professional, you will be empowered to kind of guide the conversation more. Because unfortunately, in the financial world, there are people who, I don't want to call them unscrupulous, but they are more guided by self-interest than the client's interest. And there's conflicts of interest that happen all the time. And so we'll talk about that a little bit down the road, but I just want you guys to be informed so you can make great decisions for you and your family when you're thinking about, where should I be putting my money? So first thing is, I'm going to just give you a little bit of background about myself and why you should be listening to me, right? So I am a financial advisor who is also licensed as a mortgage broker. And so, you're getting the benefit of an experience from someone who actually works in the field and does this and helps families make these decisions every single day, right? So I'm not just some random person on the internet, and I'll go ahead, as a matter of fact, I'll go ahead and show you my credentials just so you know that. So anytime you're dealing with a financial professional, right? You want to go on broker check so you can kind of type their name in and, kind of see if it comes up. So if I type my name in and go ahead and just hit search, boom, my name comes up. You can see my license number, the firm I'm with, and how I'm registered. I'm an investment advisor and a broker, right? So again, the other thing too, you can go to NMLS right there, type my name in, boom, my NMLS number comes up, boom, right there. So just wanted to show you that. And anytime you are dealing with someone, that's a nice way to kind of verify their credentials, right? Because a lot of times, unfortunately, you have life insurance agents and professionals masquerading as a financial advisor. You are not allowed to use that title or monicum unless you are registered with FINRA, right? I am registered with FINRA. I took all the requisite exams and passed all the licensing to be registered with FINRA, took all the tests. It was very grueling, but it was worth it. So with that out of the way, we're going to get into the meat and potatoes of the video. So I'm going to share my screen with you once more so we can really get into today's subject matter. So boom, we come over here, and so we're going to be rating these accounts one by one. So the first account we're going to start off with is something that everybody kind of knows and is familiar with at this point: 401ks. Right? So I'm going to put 401ks into the B tier. Now, this might surprise a lot of people watching this video because they're like, oh my God, I thought, 401ks were great. Well, remember at the beginning of this video, I told you there's going to be pros and cons for each of the accounts. And while 401ks are very good, they are basically training wheels for they are the training wheels of retirement. They are not there to guarantee you any financial standard of living in retirement, because some people participate in them, some people don't. Some people max them out, some people don't. Some people only participate up until the employer match. Some people don't want to have their income reduced by $23,000 a year or can't afford to, right? So it just depends. The other thing is, in a 401k, your options that you select are limited. And with that, there are default options that you select when you go to sign up for a 401k at your job. And so most people, unfortunately, they're not sophisticated enough to know what to pick and what to stay away from. And so they kind of just go with the default options. And the problem with that is that those default portfolios are like training wheels. They're okay. You won't crash, but you won't do really well either. So, the other unfortunate thing about 401ks is that even though I'm a licensed financial advisor, I cannot give you advice on what to pick inside of a 401k. It's an ERISA law. Basically, the Department of Labor holds anybody who gives advice on a 401k responsible for the outcomes, right? And the legal repercussions that come with that. And so even as a financial advisor, you're not allowed to tell your clients what stuff in their 401k they should be picking or how to structure it. But there are things you can do to still help them figure that out without coming out and explicitly telling them, right? I disagree with that law. I don't think it's right, because you can basically give advice on anything else investment wise. So why would that be excluded? But anyway, the purpose of this video is to talk about the order of how you should be thinking about the account. So I put it in B tier because for me, I recognize the downsides of it. There are no guarantees with the 401k. Like I said, you save whatever you save, and that lasts you however long it lasts you in retirement. And there's no guarantee that you're going to save up a specific amount. And most times nowadays, you and I both know that most people don't work for the same company for 30, 40, 50 years the way they used to. So now people got 2, 3, 4, 5 401ks just sitting around, right? They haven't consolidated them. They just go from one job to another, and so the average 401k balance is going to be very low. Okay. And relative to how it was in the past. And for just a little bit of history for you, 401ks were they replaced pension plans, because once upon a time, back before 401ks came on the scene in the 70s, companies had what's called pension plans, and those pension plans paid out a guaranteed sum of money to you for the rest of your life every month, right? But as you can imagine, that's very expensive. If you're a company that has tens of thousands or hundreds of thousands of employees and you have to guarantee someone income for life, that's not very friendly to the company's bottom line. So financial companies figured out a way to kill two birds with one stone, to make it so that the company doesn't have to bear that liability and make it so that employees can still save for retirement. So now the onus is on you with your 401k. So I just want you to know, just because you have a 401k, that doesn't mean you're okay, right? So I have a lot of clients, a lot of people I talk to, they say, oh my gosh, I'm okay, I'm good, I have a 401k at work. That does not mean nothing, because you don't know how it's structured. You don't know what investments are inside it. You don't know what their track record of performance is. You don't know how much money you're going to accumulate after it's all said and done. So those are all variables. So most times people accumulate $200,000 to $300,000 at the most, right? Because remember, I told you people are moving from company to company to company, right? So if you retire at 65, I don't know how long, if you live for another 20 years, 15, 20, 25 years, I don't know how long 200,000-300,000 is supposed to last you, right? So you keep that in mind. So for most people, I would say you need to put at least enough in your 401k to get the employer match. Up to the employer match, and then you can take everything else and invest it outside of work. Which brings me to the next account we're going to talk about, which is annuities. Now, annuities, I'm going to put them in A tier. I'm going to put them above 401ks. And the reason for this, and just in case you don't know what an annuity is, it's a life insurance. It's a contract with the life insurance company that basically says, the life insurance company says, hey, if you give me that $300,000, $400,000, $500,000 you saved up all these years in your 401k or wherever else you saved it, I will make sure that you get a guaranteed income for the rest of your life. You never outlive your money. And so that's why annuities are so popular, because they do what 401ks can't do. They give you a guaranteed income for life, right? And they have a death benefit. So let's say you are 65 and you're looking to retire and you got $500,000-$600,000 saved in your 401k, and you go to the insurance company and say, hey, I want to purchase an annuity. And I'd like to start receiving payments, next month. You give them that $600,000, they'll give you X amount for the rest of your life. And when you die, they will pay it to your spouse as well. So, and of course, there's some caveats and other things in there that, we don't have time to go over in this video, but annuities are very good if you don't want to outlive your money. Okay. And it's a tax advantaged account because the money that you put in is tax deferred until it comes out, right? So, and it's the same thing with 401ks, right? 401ks reduce your taxable income, right? And you don't pay any taxes on the money going in, but you pay taxes when it comes out. Same thing with annuities, right? So annuities are super cool. They have a death benefit and they have a broader range of investment options. Now, they are more expensive than 401ks. The fee structure in 401ks is usually very, 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 very low. The fee structure on annuities is typically pretty high, upwards of 5%. And there's surrender charges too. So if you do get an annuity, it's an irreversible contract. You can't get your money out after you annuitize. There's two phases. I don't want to get too deep, but without getting too deep, I will say there's two phases of an annuity. There's the accumulation phase, and then there's the annuitization phase. Okay. The accumulation phase is if you just open an annuity at 40 and you're just putting money in every month, right? Until you get to a certain amount, and then you annuitize. Basically, you turn on the income. That's what annuitize means. Once you turn on the income, you can't take the money out anymore. It's done. Before you annuitize, if you're in the accumulation phase, if it's a deferred annuity, you can take money out. Now you're going to get hit. if you're not 59 and a half, you're going to get hit with some, penalties with the IRS. So don't do that. But you can, for certain things, there's leeways and asterisks with everything. But if you can still access the money. You can still, do a 1035 exchange and move it somewhere else, right? You can't do it after you annuitize. So that's the other thing. And while you're in the accumulation phase, if you do take money out and go put it somewhere else, there's surrender charges. Usually those surrender charges go down the longer you have the account open for. So usually the surrender charges are basically spread out over 7 to 8 years, depending on what company you go with. So the reason for the surrender charges is if you have to guarantee someone income for the rest of their life, you want to make sure that you get to a certain amount, or that you can, be able to cover your costs to do that, because guaranteeing someone's income is, like we talked about with pensions, is very expensive. That's why annuities typically are expensive financial products, because they literally have to guarantee you income for the rest of your life. And it does not matter how the investment performs. They still have to give you that same amount. Now, there's other types of annuities. Yes, we know, for you financial gurus who are watching, there's not just one type of annuity. There's indexed annuities, there's variable annuities, but we're not here to talk about all that and go over the nuances, right? We're here to just talk about in general, right? And how these rank. So A tier for annuities. Okay, the next account we're going to talk about is IRAs, traditional IRAs. So I would put traditional IRAs in S tier, right? And the reason for this is because you have so many benefits with a traditional IRA, right? First of all, you get a tax deduction for contributing to it. So in this year, 2024, the maximum contribution is $77,000. Okay, so that means you can reduce your taxable income by $7,000 for this year, and so that can be enough to maybe, depending on how much you make, take you down a tax bracket potentially, right? Saving you a little bit of money there. But more importantly, you don't pay any taxes on the money until you go to take it out, right? So it has a lot of the same benefits as a 401k. So let's say you already have a 401k at work and you're contributing at least up to the max, if not more, and you still have money left over after you pay all your bills, and you're one of those people fortunate enough to say, okay, my bills are paid, I want to build wealth for retirement. A traditional IRA is a great way to do that. There are not income limitations. With an annuity, typically they want you to be at least 40 or over, unless you win the lottery, then you can open up an annuity. It's a good idea to open up an annuity if you win the lottery, because you get to avoid all that tax, that upfront tax hit, right? So, annuities are typically for older people, unless you've accumulated a lot of money early. Now, again, you can also contribute monthly. You can have a deferred annuity too, but you still typically are like 40 and older, right? So the next thing we're going to talk about is Roth IRAs. Now, Roth IRAs is, if there was a tier above S, that's where I would put Roth IRAs, because Roth IRAs are probably the best retirement account possible. And the reason for that is multi-tiered. Number one is there's no taxes on that money ever. So you're putting pre-tax money in an account that grows tax-free. There is no other account where you can put your money in where it literally, you can take it out tax-free. Now, relax, people in the comments. Some people are like, oh, IULs and whole life and infinite banking. We'll get to that. There's a difference in the tax advantageness of those plans. In a Roth, the money is tax-free, not because you have to borrow it. See, here's the thing. It's a little funny trick that they do, because when you borrow money, there's no taxes on borrowed money. So yeah, of course. But with a Roth, you don't have to borrow your own money, right? So, or you don't have to take loans out against it, right? It's your money 100% day one, and it starts to accumulate from day one. We'll talk about IULs and whole life later, but Roth IRAs are amazing tool for retirement. Absolutely monster, right? They have income limits though, because the IRS is like, wait a minute now, we don't want wealthy people being able to get all this money tax-free. It also has limitations. You can only, just like the traditional, it's only $7,000 a year, but that limit goes up every year by $500 typically. So every year you can contribute more and more, and that more and more will compound over time, right? So Roth IRAs, and here's the thing, there's no RMDs or required minimum distributions with Roth IRAs. What that means is, in all the accounts we talked about so far, remember, they're tax deferred, so you pay the taxes when the money comes out. The government is going to run out of patience and say, hey, you've had these accounts for X amount of years. Once you get to a certain age, they make you take income from those accounts so they can start collecting tax revenue. You don't have to worry about that with a Roth, because guess what? There is no taxes. So there's not going to be any money the government gets. So, there's no required minimum distribution. So you can literally start taking, payments from a Roth at 85. You could never do that with a traditional IRA, annuity, or 401k. So that's the other thing. And it gets better. If you have the account open for 5 years, you can take money out of it. without any penalty from the IRS, as long as it's your principal. You can touch your principal, but you can't touch the growth. That is why the Roth IRA is literally the best thing smoking. If you're married, you need to have a spousal. You both need to have a Roth, $14,000 a year, in max amount if you can afford it. I'm telling you, it's the best thing ever. All right. Next thing, it can only go downhill from here. So why don't we go with CDs? So CDs at your bank. You go down to the bank. Let me get a CD, right? Let me get a 5-year CD. Let me get a 10-year CD. Just no. Like, this is like literally one of the worst places you can put money, because yes, there is a guaranteed return. But here's the thing I need you to understand about investing. There's an old saying, no risk it, no biscuit. And that is a very apt term for investing. The less risk you take, the less return you get. And the reason why CDs are down here is because they give out very small returns. Now, when interest rates go up, if you're in a high interest rate environment like we are now, CDs could be okay, right? They could pay like 3-4%, right? But I want you guys to think about all of these investment vehicles like a car that's going to get you to where you want to go, right? Are you going to get, if we had to go to California for a wedding and we had to be there tomorrow, we could walk, we could catch the bus, we could bike, you know, we could fly, right? But what would make the most sense given how fast we need to be there? We have to fly. We can't walk. We can't catch the bus, right? And it's the same thing with investing. If you know that you have to retire at 65, if we save money in CDs, you'll never get there because it doesn't pay the rate of return. This is where the rule of 72 comes in, guys. And I don't know if anybody's ever taught you about the rule of 72, but very quickly, if you take whatever rate of return is that you're getting, wherever you're getting it from, and you divide that by 72, it tells you how long it takes for your money to double at that rate. So if we do some real quick math here on my calculator, let's see, 72 divided by what? Let's say 4%. I'm being generous. If you can get 4% in a CD right now, 18 years for your money to double. I don't know about you, but how many 18-year cycles do you have for your money to double at that rate, right? Terrible. You might as well put your money under a mattress. No CDs, okay? Next thing we're going to talk about is 529s. 529s are specific for saving for educational needs for your child or grandchildren or somebody else who you want to open up the account on the behalf of. Now, the cool thing about 529s is if you use them or if they get used for educational purposes, there is no tax on the gains in that account. 529s are A tier because it can be a vehicle to help avoid taxation, right? And anything that helps you avoid taxation is very good, right? Now, some people, oh, well, what if you don't use the money for education? Well, then you got to pay taxes on it. But here's the good news. Thanks to the cedz𝗹𝗪 2.0 Act that just passed last year, now you get to roll over a small portion of your 529 up to a certain amount into a IRA. Look at that. So now, even if you don't go to college, you can start a retirement plan for this person, whether it's a child or grandchild or whatever the case may be. So 529s are definitely A tier. But they do have the drawback of being specific for educational stuff, right? And so, but yeah, I mean, it's definitely a nice little tax shelter, right? So the next thing we're going to talk about is HSAs. HSAs, same thing, A tier, because they have that. HSAs is a health savings account. So if you have any premiums, if you have any co-pays, anything like that, you can use your HSA to cover those. Now they do have limits. You can only contribute a certain limit to it every year, but like the traditional and Roth IRA, it reduces your tax bill, right? So you have all of these ways to reduce your tax bill, right? Nobody talks about it, but it's there for you to take advantage of. Now, again, the only downside with the HSA is it has to be health-related expenses, right? But the cool thing is it's another tax haven for your money, because here's the other problem that nobody thinks about. We're going to get old someday. Everybody watching this video, someday, well, hopefully, if you live long enough, right? Knock on wood, we're all going to live to get old. Most people, when you're young, you don't think about how expensive healthcare is when you get old. You don't, maybe you thinking you're not going to need that. But an HSA is a really great way to save, to prepare for those type of expenses. If you start early enough and you don't want to buy long-term care insurance, right? Because there's no guarantee you're going to need, long-term care. But if you have an HSA, that's more money sitting there that's yours versus having a, long-term care policy where you've paid them all this money. And then if you don't become ambulatory or you have to go into a convalescent home, then that's, tens of thousands of dollars, you're out. With the HSA, you can avoid that and, basically self-insure. All right. And so, that's cool. And then we've got a savings account, right? Bank account. I'm going to put this at C tier because some savings accounts, like right now, a lot of brokers like Webull and, what's the other ones? Gosh, it's right on top of my head. Robinhood, they are giving people, 5% a month, basically, for all the money that's in their account. Now, that sounds really good, and it's risk-free, too. As long as you have your money sitting in there, they pay you every month. But here's the problem with those accounts. That interest rate that you're getting is not guaranteed because interest rates change all the time. So eventually, when we have a recession, the Federal Reserve will lower interest rates. And guess what's going to happen to that 5%? It's going to go down to 4, 3, 2, 1, 0, right? So you don't want to expose yourself to that, right? So it sounds good when interest rates are high, but they're not going to stay high forever, right? So while it's true in some brokerage accounts, you can take advantage of that, it's not all of them, and it's not stable forever. And the other thing is like bank accounts, CDs, stuff like that, where it's just your money's just parked there. Remember, every day your money is losing value because more and more money is printed every day. The United States prints money every day. And the money, the value of the new money that gets printed comes from the old value that's all the value of the old money that's already in circulation, right? So under the mattress, CDs, savings accounts, bank accounts, you don't want to keep a ton of cash there. Although you do want to have an emergency fund, right? Which is A tier. Nice segue, right? An emergency fund is 3 to 6 months of your annual income saved up in an account where it's liquid. Now, if you have an emergency fund in a brokerage account that's paying 5%, I got no problem with that. That's fine, right? Because an emergency fund can be in a multitude of different accounts and it could be invested in any number of ways, but you need to have one. Most people, credit card debt is over $1 trillion, right? Student loans, all of those things, right? Because life is going to happen. Your car is going to break down. Your roof is going to collapse, or there's going to be a leaky roof, or your hot water tank is going to go. And when those things happen, what do most people do? They put it on a credit card, right? They pay interest on something 6 months from now that they bought 12 months ago. Don't do that. have an emergency fund, right? Next thing, now we can get down to the nitty gritty here. So we're going to use whole life. Whole life. And remember, I said this is contextualized as where to put your money. Okay. Whole life is going to be D tier. Now, there's some people that's going to have a problem with that. And I'm going to tell you why. Whole life is an insurance product. It's not an investment. Okay. The insurance department and FINRA and the SEC do not classify whole life insurance as an investment. If you see a financial representative or a insurance agent trying to sell whole life as an investment, they are in violation of state and federal law, because whole life insurance is not an investment. It's a life insurance policy with a savings account attached to it. Okay. So the problem I have with whole life is that while there are a minimum guaranteed payout, kind of like a savings account, how you access your money is one of the problems I have with the whole life. So imagine if you went down to the bank and they said, hey, Mr. or Mrs. Customer, when you open up this account for the first 2 years, you're going to have a zero balance. Okay. So you're going to deposit, you're going to get direct deposit with us for 2 years. You're going to have a zero balance, right? After the 2 years is over and you start to accumulate, your direct deposits start to accumulate after 2 years. In order to, when you go to take money out the ATM, you're going to have to borrow it and pay us 5 to 8% to get it. So how do you like that so far? And here's the best part. When you die, we don't want your family taking, fighting over the money, so we'll just keep it. Would anybody in their right mind ever open an account that works that way? Heck no. Well, guess what, guys? Those are that little funny banking rules. Those are all written as what's called guaranteed values of whole life insurance. So look, if you want to buy whole life, you can. I'm not knocking it. I'm just telling you the downsides of it. It is not a great place to save your money. There are very bad downsides to putting money into a whole life policy. And here's the other problem with whole life. Let's say you have a whole life policy for 40, 50 years and you've accumulated, 30 grand in that 40, 50 years, right? Remember what I told you earlier in the video about the rule of 72, right? So that's obviously not going to be enough for you to do anything with. So your wife or your spouse comes to you and says, hey, why don't we take that $30,000 and go buy a car or do something with it? And you're like, okay, well, I was just sitting there. So you borrow the money, you take a policy loan against that money and your policy, right, to access it, because that's the only way you can access it without surrendering the policy is to borrow it. So you borrow it, you take it, you go down, you buy the car, and the next day you die. Let's say you have a $50,000 policy, right? And let's say your funeral was planned based on that 50,000, everything, your bills were going to be paid off. Everything was based on that 50 grand policy, whole life policy you bought. And let's say the next day you die, right? With the outstanding policy loan for $30,000. Guess what happens to your death benefit if you die with the outstanding loan? It's reduced by the size of your policy loan. So now your spouse is not going to get a check for 50,000. She's only going to get a check for about 15,000, because remember, it's not just the 30,000, it's the interest too. But see, that's the stuff nobody on social media will tell you, because they're interested in be your own bank, and the commissions are higher with whole life. But that's a whole nother topic. But yeah, if you still want to buy a whole life policy after that, fine. But yeah, I just want to let you know that IULs, if there was something under D, that's where IULs would be, because at least with whole life, you never have to worry about your policy imploding or collapsing. With IULs, it's a whole different ballgame. Now, it is cool that they give you your cash value and death benefit when you die. There is an option where you can get that with IULs, unlike whole life. And there's more flexibleness because your premiums are flexible. But that's also the problem. Because you see, in an IUL, and remember I told you with whole life, it's insurance bundled with savings. Well, with IULs, it's not just any insurance that's bundled with savings. It's annual renewable term bundled with savings. And annual renewable term is a policy that the cost increase every single year as you get older. And rightfully so, because you're getting closer to passing away every year, right? So the problem with IULs is that as you get older, if you don't pay the amount to keep the policy in force, it's flexible premium. You could pay it's like your credit card. You could pay the bare minimum or you could pay overpay, right? Most people with IULs, the way they get sold, they're not structured properly. So they pay the bare minimum. And the problem with paying the bare minimum is the difference between what you're supposed to be paying and the bare minimum comes from your cash value. So guess what happens over time? If you have this policy for long enough and you don't fund it properly, it's going to implode and you will lose your cash value and your insurance. And one day you'll get a letter from the insurance company saying, hey, you owe us $2,350 a month to keep this policy in force, or you have no coverage. And by the way, all your cash value that you spent 20, 30, 40 years in this policy because somebody on social media sold you this policy 20, 30 years ago. Well, I don't know what to tell you, ma'am, sir, out of luck. That is why I hate these policies. Now, listen, with that said, there are utilities, there's certain utilities for these policies for wealthy people and people who are very sharp and know exactly what they're doing and they're in and out. And they have specific niche use cases. But for everyday mom and pops, listen, I showed you my credentials. I do this every day for a living. If you don't believe me, go listen. Go type into YouTube right now, Dave Ramsey, IUL's whole life. And if you don't like Dave Ramsey, go type in Susie Orman, IUL's whole life. Go type in Google all the horror stories about IULs. Go on Reddit. Just type in the insurance subreddit, IULs, and you will see all the people who go on there. Oh my God, I don't know what to do. My policy imploded. I just got a letter from XYZ company saying my policy's, no longer valid. It lapsed. What's going on? I'm telling you guys, IULs are probably the worst place to put your money, especially if you don't have any of this stuff yet. If you've got all of this stuff up here or most of it, then and only then can you even think about getting an IUL. And you better know exactly what you're doing and it better be structured properly, because if it's not, you're going to be another horror story. Okay. Now, last account, managed accounts. I'm going to put them A tier because managed accounts are like chameleons. They can be whatever you want them to be. They come with professional management. And unlike a lot of these other accounts, they charge you what's basically called a wrap fee, where you don't pay for like transactions that occur in the account. They just charge you a percentage of the assets under management. But the cool thing about managed accounts is they can be tax-free. They invest in things that are tax-free, like municipal bonds. They can be tax advantage. You can do tax loss harvesting. A lot of institutions are moving their money to managed accounts now. And so it's like the new kid on the block in terms, and not a lot of people know about them. Not a lot of people talk about them, but they are very versatile and you can do a tremendous amount of things with managed accounts, and you get professional money management. There's a fund manager that manages the funds, makes the trades for the account, right, on behalf of it. So you can just sit back and not have to worry about that. You know, if you're not a DIY investor, or if you're more like, hey, I don't understand this stuff, set it and forget it, a managed account is for you. So, to summarize, 401k at work, contribute up to the max, the employer match. If you have any more money left over, get an IRA. or Roth IRA, depending on what your income is, because there are income limits. If you make over $160,000 as a single income earner, you cannot contribute to a Roth, but you can do a backdoor Roth. That's a subject for another video. This video is gone long enough. If you've able to max out your IRA and Roth IRA, maybe you want to think about opening up an emergency fund, right? Because you want to make sure you're good if anything ever happens or you lose your job or whatever. Life is gonna life, right? So once you have your emergency fund, your 401k, your IRAs going on, right? If you got kids, you want to think maybe, and you want to save more in taxes, maybe you start thinking about a 529, right? Depending on how old you are, if you're in your upper 40s and into your 50s, maybe you want to start thinking about an annuity if you've got all those things maxed too, right? And then if after all of that's done, then you can move on to a managed account. And the other downside with managed accounts is that you have to have $25,000 or more to even open this account. So you can't open this account with $5,000 or $10,000. Like it's really for, advanced, upper middle income investors, so to speak. But there's a hack. You can save a whole bunch of money. And by the way, in a managed account, you can have a Roth IRA inside of a managed account. The managed account is just a shell, right? You can have a traditional IRA inside of a managed account. You can have, some of these other things in a savings account or, inside of a managed account. That's the cool thing because it's very versatile. So, and you don't have to pay any trading fees in a managed account either because it's all included in your management fee. So, and once you have all those things maxed out, then you can say, okay, maybe some whole life in IULs, but remember what I told you about them. Be very strategic, know what you're doing, and work with someone who's going to structure it correctly. Now, if you appreciate this knowledge, and you are interested in, kind of coming up with, getting a plan in place for you, you can contact me. I'll have my information in the bottom of this video, so you can reach out to me. We can set up a free consultation and I can sit down and help you figure out what order is best for you specifically, because remember, this is just general guidelines. This is just general information. So this is kind of how I would be thinking about these accounts if you're going to open them. So we're going to make more videos. This is going to be a series, and we're going to make more videos about investing and where you should put money and how you should be thinking about doing stuff. So